they chose, so there's two ways that different businesses deal with cost flow assumptions. The first is what's called a periodic system, and the second is called a perpetual system. And so I noticed our course designers that all of the assignment problems I looked at, so in the quiz access and in the quiz, they were all periodic, using the periodic system. So I'm going to focus on that tonight. Some courses you take will have both. I'll tell you, most college courses I see nowadays focus on perpetual because it's actually what's more in use in most businesses. But periodic's probably easier, and I'm guessing the intent of the course designers is that if you learn either one of them, you can pick up the other one pretty easily, and a periodic's probably a little easier. And a lot of people taking this accounting class are not accounting majors. They're people who are going into all sorts of aspects of business and don't need to know all the deeper doctrines of accounting. If you go on to study accounting and take intermediate accounting and then on to graduate level accounting stuff, you'll get more of that than you ever dreamed. And so I think that's why they chose one, and we'll use that. So let's see, I'm hearing some background noise. I'm gonna mute, there we go. So just so you know, everybody's muted. So if you do have a question, make sure you hit unmute or at least press your space bar. All right, so let's talk about cost flow assumption. Here's the idea. The idea is, for many products, it's pretty much impossible to know which product you're selling. And in other words, if you have a store that sells canned goods and you sell a can of peas, and the peas you have sitting on the shelf were bought in 3 different shipments, and each shipment cost you a tiny bit different, how do you know if you're selling the can of peas that cost you 88 cents or if you're selling the can of peas that cost 91 cents? It's just nearly impossible to know. And take that on the scale of a business like Walmart or other massive retailers. It's just nearly impossible for them to know. And so what businesses do is they decide to use some form of cost flow assumption, meaning we're going to assume that either like what I have up on the screen here is that the first in is the first out, meaning we're going to assume always that when we sell a product, it's the oldest product that we're selling. Normally you would do that if that was how you modeled your business. So even though cost flows don't have to exactly match what's happening in real life, they should sort of match your basic model. So if your model is to, when you get new products, put them at the back of the shelf so that the older products are moved out to the front, well, first in, first out is what you're trying to do, right? Other businesses, especially businesses in tech-heavy industries where there's rapid change of product, will use last in, first out. Somebody like Apple probably does. I don't know how they do their books, but they're always coming out with new technology and then selling a lot more of the new stuff than they are of the old stuff. And so their model would be to say, we're going to assume the more recently purchased products are the ones we're selling. The third that's on here is what's called a weighted average. It's probably the most conservative approach to say, well, we don't know really if it's the first in that's going out first or the last in. So we'll take an average. And in essence, each time we buy more product, we'll recalculate how much that product costs us as an average, and we'll use that as our estimate of how much it costs. And then one that's not on this screen is what's called specific identification. And specific identification is where you actually can specifically identify exactly which product you're selling. A good example of a business that uses specific identification to manage their inventory would be like a car dealership. They probably only have a couple hundred cars in inventory at a given time. Maybe a big one has 500 or something, but most probably have 150 to 250 cars. Every car has a unique vehicle identification number. And so most car dealerships I know track each piece of inventory with its unique identifier. They know exactly how much they paid for it, any parts or labor they had to put into it, if it's a used car to get it ready to go. And then when they sell it, they know exactly what their cost was. But that probably wouldn't work if you were selling cans of peas. So usually specific identification is for expensive products that where businesses keep a relatively small inventory. Jewelry stores are another good example, like a high-end jeweler. we'll do specific identification on the high-end pieces, at least. So those are the, I guess, 4 ways that businesses deal with inventory cost flow assumptions. So a couple features here on the screen. In, first out, again, that assumes that the oldest inventory you have is the first to sell. Okay, so and always what's impacted by this is what's called our cost of goods sold. That's the expense, which is the actual cost of the goods we're selling. And our inventory, the amount of inventory that's remaining there at the end of the period. So in first in, first out, we would assume our oldest piece sold and that our newest ones, the more recently purchased ones, are still sitting there in inventory. With last in, first out, we assume our newest inventory sold and the ones still in inventory are the older ones. And with weighted average, we'd add up the cost of all of them, divide, find an average, and use that for our cost of goods sold and that average cost to calculate our remaining inventory. So you can see in this case, the same business purchased 3 items, sold 1, and they have different cost of goods sold and different ending inventories just based on their inventory cost flow assumption. So yes, the IRS does care which one you choose because it impacts your net income, which impacts how much taxes you pay. But they don't care so much. They're going to tell you what to do. What they're going to say is be consistent. If you can't change it up just so that you get a better better tax treatment this time than last. If you be consistent, you'll be safe with the IRS. If you change, then you have to justify it. Okay. Anyway, so that's cost flow assumptions, the basic idea of them. So in a periodic inventory system, in essence, what we have is our beginning inventory, stuff we had at the beginning of the month or the quarter or the year, whatever the time period is we're measuring, plus any net purchases. That means stuff we bought. That equals our merchandise available for sale. And then at the end of the month, we'll have our ending inventory, which is the products we have left over to sell, and then our cost of goods sold, which is the cost of all the stuff that we sold. So that's sort of how the math of it works. What you had plus what you purchased is what's available for sale, and then what you sold plus what's still left over should also equal that. So it flows in and out. All right. So the accounts we're dealing with when we're worried about inventory is the inventory account, or sometimes it's called merchandise inventory on our balance sheet, and the cost of goods account that's on our income statement, cost of goods sold, which is an expense. And so that's all that really gets impacted by all of these decisions. Which cost flow assumption are we going to use? So here's an example of a company that had a beginning inventory of 10 units. We don't know what kind of product they sell, but they had 10 units that had a cost of $91 a piece. So total cost of those units, $910.
Right. Wow.
Again, I'd ask you to stay on mute unless you're going to ask a question. I keep getting a lot of background like noise coming in. So then they purchased 15 units for $106 a piece. Total cost of that purchase was $15.90. Sold 20 units for $130 a piece. Purchased 20 units for $115. Purchased 10 units at $119. And then sold units for $150. Don't get confused by this price over here, which tells you how much they sold it for. It doesn't tell you the cost of the units that were sold. Okay. At the end of the period, they have 12 units left. Over the period, they had 55 total units available for sale. The cost of those goods that were available for sale was $5,990, and they'd sold 43 units, had 12 units remaining. So that's what all of this information tells us. And so the question that comes to our mind is like, okay, well, which units did they sell? And how do we know which units they sold? And the answer is we don't know. And so we're gonna have to make an assumption using one of those costing assumption methods. So the first one is the specific identification method. So when you see a problem that's asking you to use the specific identification method, it won't always say, hey, use the specific identification method. Instead, it will give you some type of information like, we sold on this date, we sold 8 bikes that cost 91 and 12 bikes that cost 106. And on this date, we sold 23 bikes, 2 of them that cost 91, 3 that cost 106, and 15 costing 115. So it's going to give you specific information about what the cost of the products were. What's nice about these is it's kind of easy, because once you know exactly which ones sold, you just take the cost times the number sold, and you can calculate exactly what your cost of goods sold was. And then you also know which units didn't sell, which units are still there, and you take those costs times the number still sitting there, and that gives you the value of your ending inventory. So you can see here they had to figure out that here was 5,990 was the total cost of all of the units. And then 8 times 91 plus 12 times 106 for the sale on 8/14, so $2,000 worth. And then August 30th, 2 at 91, 3 at 106, 5 at 115, 3 at 119, 25.82. We can add all that up, and it tells us the cost of the goods we sold. And then if we take the total cost of units available minus the cost of goods sold, it's going to tell us what our ending inventory is. And so I like these kind because they're pretty easy. In real life, depending on the type of the number of units you have in inventory and the type of system you're using, this can be pretty easy too, because your computer can take care of all that for you. So the second type way we might look at this is using first in, first out. So under the first in, first out system, we're going to assume the oldest units are the ones we sold. So if we go back up, I'm going to just show you this again. So when I so on my first sale here on August 14th, I sell 20 units. Which units did I sell? Well, I sold the oldest ones. It would have to be 10 of those plus 10 that I purchased there. So we can see, are they using the same numbers here? I guess this example uses, okay. So what they're telling us is they had 55 units available for sale. They sold 43 units, so they had 12 left over. That's what we figured out before. So the question is, what's the cost of the 12 bikes in ending inventory? So if we're assuming first in, first out, then we're going to assume that the 12 that are still in inventory are the 12 newest bikes. And so we purchased 10 at 119, and then we would use 2 more of these ones we purchased at 115. That would be the 12 that are still sitting there in ending inventory. We would assume then that we sold all of these other units. That's the assumption. So we'll do 10 at 119, which is 1190, 2 at 115, which is 230. We add those up. That gives us the ending inventory. We can subtract the ending inventory from the total cost to give us our cost of goods sold. With last in, first out, we're going to kind of do the same process, right? We're going to say, well, there's 12 units sitting there in ending inventory. Which 12 units are they? Well, in this case, we're going to assume they're the oldest units. So if we looked back at our table here, we'd say it was the 10 units I had at the beginning of the month, plus 2 more of these that I purchased on August 3rd. So it'd be 10 times 91 plus 2 times 106. That would be the cost of the units sitting there in inventory. So 10 times 91, 2 times 106. My total cost of ending inventory is 1122. Total cost minus ending inventory gives me a cost of goods sold of 48.68. What's nice about these, like they seem hard at first, but once you get comfortable with the sort of interrelationship between the numbers, they're not too bad. Like it just takes a little bit of practice with them to get comfortable with that. All right, when we have the weighted average system, what we would do is try to figure out the average cost per unit. So in this case, what we would do is we would take our total cost, we would take that total cost by multiplying the number of units times their cost, and then adding up all those costs, and we would see that all 55 of these units cost us $5,990. And then we compute the average cost per unit by taking 5,990 divided by the total number of units, 55, and we'd come out with $108.91 per unit. And then again, we could at the end of the month say, okay, or if we had 12 units in ending inventory, 12 units times 108.91 is 1307. And then the total cost, 59.90 minus the 1307, will give me my cost of goods sold. I could also calculate that by saying there's 43 units sold times an average cost of 108.91. So those are the three methods. Like I said, I think this weighted average is sort of, again, the more conservative method, because it says I don't know for sure which are first in, which are, I mean, if I sold first in, first out, or if I sold last in, first out. So I'll find this middle place by taking an average and then using that average cost to calculate both my cost of goods sold and my ending inventory. All right, there is one problem on the quiz for chapter 5 that I think there's only one that uses this terminology of understated and overstated. And understated and overstated is really confusing the first time you have to deal with it, and probably the 10th time you have to deal with it, until you just deal with it enough that you're like, oh, okay, I get this. So I just want to explain the term understated and the term overstated. All the term understated means is that what we have recorded on our books is less than what it really should be. Okay. And overstated means what we have recorded on our books is more than what it really should be. So if we say our inventory is understated, what we're saying is what we have recorded in our books doesn't match up with what the inventory that's really there. It's less than that. And so we understate when we make a statement that is too low, or it's lower than what's there in real life. Okay. So that goes for all these things. That's just the general meaning of the term. I know you're probably sitting there thinking, well, that was obvious. Thanks, Fox. But it can be confusing in the context of things. So here, so what they want us to do is be able to say, well, how would an error carry through in other problems? So for example, think about this. So this is your income statement, right? If my sales were understated, then my net income would also be understated, because my net income is sales minus expenses. If my sales were overstated, higher than they really were, then the error would carry through all the way to my net income. My net income would be overstated. With expenses, it's the opposite. If an expense is overstated, then my net income will be understated, because it'll look like I have too little, less net income than I really do, because the expense was showing higher than it really was. And so just seeing those relationships is challenging at first when you first do it. The other thing is, if I have an error in my ending inventory, so if my ending inventory is overstated in that first year, then that's going to carry through, because my ending inventory is going to be recorded as my beginning inventory for the next year. And so that's all they're trying to get us to do. I think it's number 9 on the quiz, and we might take a look at it if we have time. But that's all they're trying to get us to do, is recognize that these errors will carry through into the next year. And so if I have an understatement or an overstatement to ending inventory in 1 year, then I'm going to have an overstatement to beginning inventory, which is going to lead to this understatement of my cost of goods sold. And so it creates some weird problems, and it's going to it takes some working through those. Whoops. Same thing on the balance sheet. Recognize that ending inventory is an asset. So if our ending inventory is understated, then our assets are going to be understated, and our equity is going to be understated. If it's overstated, then our assets will be overstated and our equity will be overstated. So that's that's the other weird part. And so that's really it as far as like new concepts. And honestly, it's a lot. It's plenty for a chapter. The whole first in, first out, last in, first out, weighted average. That's confusing enough. You don't need a whole bunch of new stuff. There were some other new concepts that were more like book concepts that I think just reading through those parts of the chapter, there was only a few little questions that I saw that dealt with that. So the big new material is the whole inventory assumptions that you'll have to deal with this chapter.